Hi everyone, hope you're well. It's Ollie Walsh here, and in this video, I'm going to be talking about tax.
Boring.
And specifically about the new mortgage interest rules which came into effect in April 2020, and why it might influence your decision to purchase an investment property in a limited company rather than in your personal name. So let's go. Just before we start, a little disclaimer, I'm not a financial advisor or a tax advisor. Everything that I talk about in my videos, I've learned over the years through trial and error and research of my own. And it goes without saying that your situation will be unique to you. So if you're thinking about setting up your property business, I definitely recommend speaking to a financial or a tax advisor so that they can tailor their advice specific to your situation. And you definitely should not solely rely on some from YouTube. And on that bombshell, let's dive in. So everything I'm about to talk about relates to purchasing property in your own personal name rather than in a limited company. So to start with, let's set some background. So pre-April 2017, you could deduct your mortgage interest along with all other costs before determining your taxable profit. So let's take an example. Let's say you had a rental income of £10,000 and you're paying mortgage interest costs of £5,000. Let's also say that you had other costs of £1,000, maintenance costs, maybe management fees, that kind of thing. So adding all this together, you have a profit of £4,000. £10,000 income minus £5,000 mortgage interest minus other costs of £1,000 leaves £4,000 of profit. That is profit before tax. So let's see what the different tax implications are based on whether you're a lower or higher rate taxpayer. So if you're a lower rate taxpayer earning under £50,000 a year, you will pay the basic rate of tax, which is 20%. So we take 20% of your profit, 20% of 4,000 is £800, and that leaves you with a profit after tax of £3,200. Now, if you're a higher rate taxpayer earning over £50,000, you're going to be paying a tax rate of 40%. So 40% of £4,000 is £1,600. So your profit after tax is £4,000 minus £1,600 of tax, which leaves you with £2,400. So now let's take a look at the impact of the new rules which came into full effect in April 2020 on the same scenario. So as of April 2020, you're no longer allowed to deduct your mortgage interest costs from your taxable profits if the property is owned in an individual's name rather than a limited company. Instead, you'll be able to claim a basic rate allowance for your mortgage interest costs, irrespective of your marginal rate of tax. So let's see how that affects our example. So again, we start with rental income of £10,000 and we have mortgage interest of £5,000. Now in this scenario, interest is not tax deductible. We still have our other costs, maintenance, maybe agent's fees of £1,000. However, our profit is now considered to be £9,000 as opposed to the £4,000 in the old rules, because we're no longer taking into account the mortgage interest costs. So with a profit of £9,000, a lower rate taxpayer who's earning under £50,000, who will be paying a basic rate tax of 20%, will therefore be liable for £1,800 of tax. And a higher rate taxpayer who's going to be paying 40% tax is going to be liable for £3,600 of tax. So you can see that's quite a big difference. In the old scenario, the tax liability for a lower rate taxpayer was £800, and in the new scenario, it's £1,000 more at £1,800. And similarly, in the old scenario, the higher rate taxpayer's liability was £1,600, and in the new scenario, it's more than double that at £3,600. But wait, there's more. It's not quite as bad as that. As I mentioned before, everyone, no matter your marginal rate of tax, so no matter whether you're a higher or lower rate taxpayer, gets to claim a basic rate reduction of 20% of your mortgage interest costs. So in this case, with mortgage interest costs of £5,000, everyone, no matter if you're a higher or lower rate taxpayer, will be able to claim back an £1,000 deduction, 20% of the £5,000. So how does that work out then? So we've got the £1,000 deduction. The lower rate taxpayer was eligible for £1,800 of tax. We take £1,000 off that tax bill and we're left with the lower rate taxpayer having a liability of £800, leaving them with a profit after tax of £3,200. You'll notice that this is exactly the same as in the old scenario. It's just calculated a bit differently. So there's no change for the basic rate taxpayer in the old and new scenario in that respect. But wait, there's more. But before we come on to that, the higher rate taxpayer was liable for a £3,600 tax bill. We take off the £1,000 relief, which leaves us with £2,600 tax bill. And that is considerably more than in the old scenario. So with the old rules, higher rate taxpayer was liable for £1,600 of tax. With the new rules, it's £1,000 more at £2,600. So it's quite a considerable difference. So now you might think that in the old and the new scenario, the basic rate taxpayer who pays a tax rate of 20% is going to be completely unaffected because their tax liability in both scenarios is exactly the same. Now, while that is the case, they are affected in another way. Now, as I mentioned before, what is considered to be profit in both scenarios has changed. So previously, under the old rules, with this scenario, there would have been £4,000 of profit. However, with the new scenario, there's £9,000 of profit. So this means that a lower rate taxpayer will more quickly be pushed into the higher rate of tax. So to put that into context, the upper threshold for the lower rate tax band is currently £50,000. So let's say you have a lower rate taxpayer currently earning £40,000 from their salary and an extra £5,000 from various investments, and they have a property that they're considering buying. Now, in the old rules, if they were to buy this property, they would be making a profit of £4,000. So that would bump up their overall income to £49,000. However, under the new rules, the profit they'll be making is £9,000. So that'll make their overall income increase to £54,000, pushing them into the higher 40% tax bracket by £4,000. So on that £4,000 that they're over the higher rate tax bracket, they're going to be paying the higher rate of tax of 40%. So what does this all mean for you? Well, if you're a higher rate taxpayer or you think you might become one at some point in the future, you may want to consider setting up a limited company to purchase any of your investment properties in going forwards, because the old mortgage interest rules still apply for limited companies. But of course, as with anything, doing that throws up a whole load of other complexities, and I'll be covering all of those in a future video about limited companies. So that is all for today. I hope that was useful for you. People often have many comments and questions around tax and this kind of thing, so do drop them in the comments below and I'll be more than happy to try and answer them. As ever, if you're enjoying these videos, do subscribe to my channel, leave a comment, smash that like button, and I will see you in the next one.